talk about how to manage debt and credit. So, the Canadian Foundation for Economic Education is pleased to partner with National Bank of Canada to provide a series of workshops to help post-secondary school students across the country to get a better handle on their money. And today's topic is how to manage debt and credit. We're going to cover some very important information you will be able to action right away to take control of your money. This workshop will last about an hour, and then we will have a live Q&A for 30 minutes at the end of the presentation. These workshops are intended to serve as a foundational resource to get you thinking about your finance and not as a final stop in your financial journey. Consider the information and see how you can apply the concepts covered to your personal financial situation. And also please understand that while we do our best to answer all related questions, we will not be discussing topics beyond the scope of today's conversation. If you have specific questions that we are unable to address, consider setting up an appointment with a financial professional. We sent a pre-survey we hope you completed. There will be a post-survey sent at the end of the session. If you fill out both, you will be entered into a draw for one of four $50 Tim Hortons gift cards, chosen among eligible students this semester. And don't worry, we won't use your email address for any other reason except this draw. The program, Help Managing Your Money on Campus, is designed to help support young people like you by providing with comprehensive financial education modules. This is so important and timely because more than ever, we live in a complex financial world. The majority of you have likely already experienced this world of financial cost, responsibilities, planning, spending, debt, and credit cards, and much more. And that's exactly why we have partnered with universities and colleges across the country to help equip students with the information they need to take on all of life's financial challenges. So, in the first half of 2020, we have asked students about their priorities and what they want to learn more about. And nearly 1,500 students answered our survey and from 94 different post-secondary institutions. And this is what we have found out. 48 of students said that they had difficulty generally knowing how to manage their finances. 64 of the respondents want to learn how to deal with financial stress. And 55 of the respondents wants to build a financial healthy life. Today, we're going to talk about three major topics. First, we will look at how to manage your debt, and not all debt is bad, and we will explain good and bad debt. Also, always make sure to understand all of the terms of any sort of debt and borrowing before you sign on the dotted line. Second, we want to talk to you about using credit cards. These can be good tools to use, but you must understand how punitive it can be if you don't pay off your balance in full every month. Lastly, we will discuss what impacts and how you can improve your credit score and also request free annual credit reports. Coming out of this workshop, you will understand how credit cards work and the terminology you need to understand when getting a credit card. Second, why it's important to pay off credit card in full monthly. And third, how to improve your credit score and how to manage your debt as to reduce your financial stress. The first topic we'll be discussing today is how to manage your debt. Most students will have to borrow money to pay for school, even if it's from the bank of mom and dad. Here's what we'll cover in this section. What does the word debt mean to you? There are many types of debt that can even help you succeed and get ahead. And we'll talk about some ways to lower debt if you have too much debt. What do you think of when you hear the word debt? If you want, you can think about it and put some answers in the chat. What do you think of when you hear the word debt? There are some words that is credit, debt, liability, loans, bank, payment, bill, note, receipt, mortgage, shares, bonds, and money. Hmm. There are many types of debt. This includes student loans, credit cards, overdraft protection in a debt account, personal loans, mortgages for home, buying, leases, and home equity. I'll explain a few of these words, what this means. Overdraft protection. It is a optional coverage through your bank to protect you from non-sufficient funds, fees, if you're spending more money than it is available in your checking account. Even with protection, you may still be charged interest on the amount your account is overdrawn. Personal loans. A loan from financial institutions taken out in your name and applied against your credit score. Proper use of a personal loan, including timely payments, may improve your credit score while failing to make payments will hurt your score. Now let's look at a video where it shows the difference between good and bad debt.
Welcome to the Wonga Money Academy. In this episode, we look at debt, one of the 4 pillars of financial literacy. Fortunately, it isn't difficult to understand. Debt is simply money you've borrowed and have to pay back later, and most people will have debt at some point in their lives. Think carefully before putting yourself in this position, as the amount of money you pay back is always more than what you borrow. This is because credit providers offer a service that comes with a fee. They work out the fee by adding a percentage of what you borrow to your monthly installments, and it's called interest. There's also a difference between taking on good debt compared to bad debt. Borrowing money to pay for things you don't need counts as bad debt. Expensive clothes, the latest electronics, or pricey holidays, once they're worn out, burnt out, or over, you'll have nothing to show for them. Take buying a brand new car, for example. It will definitely lose its value and perhaps put you in a tough spot as well. What if you lost your job and couldn't keep up with the repayments? You might end up with a loan that's greater than the amount you could sell the car for. That would leave you with no car, plus an outstanding debt to pay. Credit card debt is always bad because the interest rates are a lot higher, usually in the double digits. In many cases, if you can only make the minimum payments, it will take you years to pay it off. Good debt applies to things like taking on a student loan for an education. In the long run, it will help you earn a higher salary, so essentially, you'll be accepting debt to get ahead in life. Taking out a home loan can also be a good debt situation. Once it's paid off, your home will be a big financial asset. The interest rates are also low compared to other credit providers. That's all on debt for now, but we'll be coming back to it later.
Says borrowing can be a good financial strategy if it helps you acquire something like a house or an education that could add to your net worth. It can also help you acquire things like a car that you can easily save up for in a timely way. As with any debt, consider the interest cost and only borrow what you can afford. So let's go through some questions you should ask before borrowing money. So, how much are you able to repay such each month? First, you have to make sure you can afford the loan and its monthly payment. It is important you do not make financial commitments you cannot afford. Do your research before applying. What is the total amount you will need to repay? It is important to calculate the accumulating interest on top of the loan within your payment schedule. Interest rate will vary depending on the type of loan. For example, if you take out a $10,000 loan and the first year the interest at 5% compounded annually would be $500 for a total of $10,500. If no payments are made, then the following year it becomes 5 interest on the $10,500 for a total of $1,025 in interest, or the loan total would be $11,025. The next question is, what does a secured loan mean? A secured loan means if you do not repay the loan, the creditor has legal claim of your assets. So this could be a house or a car, and this is based on the terms of your contract. Your interest rate on a secured loan is usually lower as the financial institutions can take something of value from you. But be aware as you don't want to lose your car or house to the bank. How long will it take me to repay the loan? Always reference the term of the loan in the contract. A good rule of thumb is the longer the term, the more interest you will have to pay. There's a PMT function in Excel which can help you understand how the term, interest rate, and number of payments can affect how much you pay each month. If I miss a payment, will the interest change? This depends entirely on the type of loan you have. An interest rate may increase if you fail to pay by the due date. It's very important to know that always read the full contract you are signing. Once you sign, you are obligated to follow the contract, and the lender has a team of lawyers who drafted their contract. Does my loan have insurance? Loan insurance may be an option, depending on your creditor. By paying into loan insurance, it is possible for the creditor to pay your monthly payment for you if you are unable to work or have become ill. This form of insurance is typically more expensive than standalone term life insurance or disability insurance, so it's important to shop around for the lowest cost if you want to pursue this angle. You may, though, get a lower interest rate on the loan if you buy this insurance as it protects the lender in case you die or can't work, and hence repay the loan. Make sure to weigh all the costs. Debt can feel like an overwhelming presence in your life. By using these tips, paying off your loan may not seem so intimidating. Consider yourself creating a payment schedule for yourself. This will also make it easier to visualize how long it will take you to fully repay your loan and make adjustments accordingly. Consider using Excel to set up the payment. This will allow you to use some of the financial functions like PMT, FE, etc. And also see what happens to how much you will owe if you pay more or less each month, or if the interest rate changes. Second is avoid paying just the minimum payment each month. This will compound the amount of interest building on the initial principal. So if you're paying 20% interest on a credit card, this will greatly increase the cost of whatever you purchased. The third tip is that if you are paid bi-weekly, you may decide to make payments every 2 weeks. This can reduce the pressure off your paycheck at the end of the month, and also versus monthly is a way to pay an extra month, which means you can pay off the loan more quickly. As an example, so if you're supposed to pay $1,000 per month, but instead you pay $5,000 every 2 weeks, on the day you get paid, then you will pay $13,000 per year versus the $12,000 per year if you paid $1,000 per month. So this is an extra $1,000 per year will help pay down the principal of the loan more quickly. So there's a Zoom poll. So what is the one thing you took away from today about how to manage your debt? So what is the one thing you took away from today about how to manage your debt? I'll give it a few more minutes for everyone to answer. A few more seconds. Okay, it says loan security. Okay, that's good to know. So I'll end the poll. Thank you for answering. So what if you have too much debt? So there are two typical approaches to paying down debt if you have too much debt. So the first one is the snowball approach, which is a start small and build up to larger debts. So, for example, if you owe $50 to X, $100 to Y, and $300 to Z, you pay off the $50 to X first, while paying at least the minimums on Y and Z. So celebrate that success and then use that confidence to pay down $100 to Y and then $300 to Z. The other approach is the avalanche, which is where you look at the debts where you have and pay down the one that is the most painful first, while paying at least the minimum on all debts. So if the interest rate on X from above is 5% and Y is 20% and Z is 10%, then you pay off Y first. That way the interest you owe that is making it hard to get out of the debt will drop the most and the quickest. I personally would suggest avalanche method, but the psychological benefits on the snowball approach can work best for some participants. So here's the key takeaways from this section. There are many different forms and features of debt. It's very important to read the contract before borrowing the money. Second, there can be good forms of debt, like for school, buying a house, buying a car to get to work, etc. A couple of potential methods to lower your outstanding debt, like snowball and avalanche methods. So the second topic we'll be discussing is how to use credit cards. If you already have a credit card, know a little bit about credit cards. Plan on opening or applying for a new one or struggle making payments, this will benefit you. Here's what we will cover in this section. What are all the components of a credit card? We will talk about various terminology and how the interest charged works on a credit card. Lastly, we will talk about what impacts your credit score, how to improve your credit score, and how to get a free credit annual report. So let's look, how do credit cards work?
Are you wondering how a credit card works? I'll explain in less time than it takes to put together a puzzle. Where's the lid with the picture on it? I'll explain in less time than it takes to put together a puzzle without the lid with the picture on it. Oh, come on. A credit card is a payment tool that allows you, for example, to buy stuff online. The card issuer gives you a credit limit and you pay it off later. You can also use it as a cash advance. That's a cash withdrawal made from your credit card. It can be really practical in some instances. Interest on cash advances is higher than on purchases, and it starts being calculated as soon as you make a withdrawal. Every month, your bank will send you a statement, including your credit card balance, minimum payment amount, and a due date. From the moment the statement is issued, you have 21 days to pay off your card. If you pay off your card in full by the due date, you won't have to pay any interest on your purchases. However, if you don't pay off the full balance by the due date, the interest will start to accumulate and will be calculated from the date you made your purchase. Calculating interest can kind of be like putting together a puzzle. A puzzle without the lid with the picture on it? But it's not that complicated. The interest rate for the things you put on your card is annual. The rate depends on which card you pick. Interest is calculated based on the amount you still owe. For example, say you owe $100 on your credit card and pay $15. Until you actually pay the $15, interest will be calculated on the full $100. After that, interest will be calculated on the remaining $85 until you pay off the card in full. If you choose not to pay off your card balance in full, the most important thing to do is make sure you pay at least the minimum amount owed by the due date. If you manage your credit well, you'll help build your credit report, which will influence your credit rating. This will come in handy when you're trying to sign the lease on a new apartment or buy a new car. Some cards offer other benefits like cashback, rewards, or purchase protection. See, credit cards can be useful. There you go. It's a credit card.
I hope everyone understood that. And now there's like few terminologies to know about credit cards, which is, so the first one is annual fee. So that means that if your credit card charges an annual fee, ask the lender if they will waive it. They may be willing to do this to keep your business or use a student card that has no fees. Balance due. Your statements will tell you what you owe and when it's due. The amount due can include any unpaid balance you owe from a previous bill, as well as any new charges, interest, late fees, or annual fees. Credit limit means that this is the amount you can borrow using your card. The lender can't change this limit without letting you know. Finance charges. If you don't pay your bill on time, these charges can include late fees plus interest. You likely pay a higher rate of interest on any cash you borrow using your card and a lower rate on money you borrow for purchases. Your credit card company treats these as two different kinds of balances. The next is the grace period. This is the time you have to pay off the balance you owe each month before you have to pay interest. In most cases, the grace period starts on the billing date and ends a certain number of days after. Under Canadian rules, if you pay off your balance in full each month, your lender must give you a grace period of at least 21 days on all new purchases. If you don't, you will pay interest on the full amount you owe back to the date of purchase or when you borrowed on your credit card. Annual percentage rate. So this includes all loan services, costs, and interest. It may be higher than the interest rate you see in the loan contract. Please note the interest rate on credit cards is variable and can change as the prime rate rises. Pay attention to any notices from your credit card company about increases. Introductory rate. This is a special offer that gives you a temporary lower APR. In most cases, the offer lasts about 6 months. Then it goes up to the normal rate for your type of card. Your lender must tell you in advance when interest rates are going to increase. Minimum monthly payment. Most cards only ask for a minimum payment each month. This is often 5% of the current balance or $10, whichever is more. Your monthly statement will tell you how long it will take to fully repay what you owe if you only make the minimum payment each month. So if you want to select a credit card, there's this website from the Government of Canada. So I will just stop sharing my screen. I'll just go through it. So this is the Government of Canada website. This is the credit card comparison tool. And here you can choose, you can select what is best for you or what type of credit card suits your needs. So the first one, your province that you're living in, which Canadian transaction or which currency you're using. Or if you're looking for a credit card with low purchase interest rate. So this can depend if you're not confident in paying back your card in full. So this is what kind of rewards you're looking for. So I'm just going to, for now, I'm just going to do the cashback and groceries. This can all depend on what you're looking for. If you have any annual interest fee, no, zero, or up to you. What's your maximum purchase interest rate, maximum cash advance interest, balance transfer rate. If you're looking for a specific bank, you can pick up to your preference. Are you a student? If you're looking for a secured card, so I'll just search according to these filters. We got 17 results according to what we chose. So these are what about the credit card. They're comparing and choose what's best for you. So I'm just going to go to the Diamond North Credit Union Cashback MasterCard. It's saying there's no annual fee. The currency is annual fee. It's saying there's no annual fee. It talks about the whole interest rate, and it's saying the minimum income required is saying $10,000. Information about rewards, and it tells you how to redeem it and other benefits of the credit card. This I would suggest everybody who's looking to get a new card to look into this website and find what's best for you or what suits your needs. Sorry about that. I'm just going to get back to my okay. So it's important to know that there are many special offers from banks while you're in school. This includes the ability to open bank accounts, debt, and credit cards without monthly fees. It is recommended to find a credit card that fits your needs. It is important to shop around for different types of credit cards before selecting one. So like I showed you in that website, I said yes to students, and some of them has no annual fee. So hopefully you'll choose what's right for you. And now we'll talk about different types of credit cards. So the first one is prepaid credit cards. A prepaid credit card is a payment card that you can use to pay for purchases. Prepaid cards can be either physical or electronic. When you use the card, the merchant deducts the amount you use from total amount on the card. So be careful of the various fees included in a prepaid credit card. And then there's secured credit card. So a secured credit card requires that you provide a security deposit to the financial institution that issues the credit card. Your credit limit is normally set as a percentage that is equal to or higher than your deposit. Depending on the credit limit your request, the security deposit may range from few hundred to a few $1,000s. So if you don't make your payments, the financial institution may use your deposit to pay the money you owe. So it's important to be careful with signing up for a secured credit card from an unknown financial institution due to needing to make a deposit. Now let's see this video, how this explains how credit card works.
If you have a large amount of credit card debt and are only making the minimum payment every month, you're not going to pay it off anytime soon. In fact, if you only make minimum payments, it could be decades before you find yourself debt-free again. Say, for example, you have $10,000 in credit card debt, which is represented by the water level in this glass. In order to pay off that $10,000, you'll need to empty that entire glass by returning the money you owe to your credit card company. So every month you pour out a little water by making your minimum payment, which is on average around $142. That payment lowers the total amount you owe to $9,858. That's a little bit lower, but not much. Unfortunately, there are outside influences that can raise that amount, mainly being interest. Interest normally charges you around 17% of your outstanding balance at the end of every month. After 17% interest on your outstanding balance is charged, that brings your new debt amount to $9,999. So after 1 month, you've paid your credit card company $142, but your total debt has only gone down by 1. The next month, if you still only make the same minimum payment of $142, your debt will be down to $9,857. But again, there's that pesky interest sneaking up on you. So after paying 17% interest again, your debt is back up to $9,998. That means after paying your credit card company $284, your total debt has only gone down by $2.
I know that was a lot of numbers, but I hope you all understood that. So, in Ontario, your minimum payment will be either the higher of a dollar amount, typically $10, or percentage of your outstanding balance, typically 3%. So it's important to look at your province since it might be different for different provinces. So if you pay the minimum, it can take several years to pay off your credit card by making the minimum monthly payment. So I'll show you an example with, I'll show you an example. I'm just going to share. I hope everybody can see that. So for example, is that suppose you owe $2,000, you have $2,000 in debt, and the interest rate is 20%, and the initial payment per month is $60. And so that is the maximum of 3% of outstanding loan. And in this example, they only pay the minimum. So $2,000 in debt can take a long time to pay off if you only pay the minimum each month. So making a minimum payment of 3% or $10, whichever is higher, and being charged 20% interest compound monthly can end up taking over 15 years to pay off and cost you about $4,241. And what's worse is that 53% of that is 4,241 was only paying interest. Another thing to note is that the minimum dollar amount will go down as you make payment. So as your principal is lower. So near the end of the payment period, or the $10 minimum monthly payment will also become the amount that you have to pay. So they only pay the minimum payment that's required, and it took them 15 years to pay off $2,000 and accumulated the interest and became 4,240. Another example, suppose if you paid $100 each month instead of paying the minimum, you would have your $2,000 paid off in just over 2 years. So that's with less than $500 in interest paid. So the more you can put toward covering high interest debt each month, the better for your bank account. So the total percentage was only 18% that they did. And it only took them 2 years to pay off $2,000. Suppose you paid $60. That's by maintaining your payment of $60 per month instead of just the minimum. You can pay off your card in just over 4 years instead of 15 years. So it's important to pay off what you can afford, but do what you can to find ways to pay more than the minimum amount. And the percentage of total payment that was the interest was 32%. Pushing the screen. Let's look at credit card fraud. So if someone steals your credit card, they may be able to run up a large amount of purchases very quickly. Typically, your bank won't make you liable for charges, but it's best to be careful as the theft of your credit card can lead to identity theft, which can be much, much worse. Some scams use your stolen credit card to make purchases. Some use the credit card to steal your identity and open more credit card under your name. Review your credit card statements to make sure that all the purchases are yours. Most bank-issued credit cards will not make you pay for any unauthorized or fraudulent transactions on your credit card. You will have to sign a statement claiming the activity was fraudulent and unauthorized. Tips when using your credit card in public places or at places of business. So first is keep your credit card in a safe place. Limit the number of credit cards you carry with you. Cover the keypad with your hand or body when covering your PIN so no one can see it. Keep your credit card in sight at all times when making a purchase. Report anything you think is suspicious about a credit card device at a business or ATM to the business head office and your credit card issuer. So what are the key takeaways from this section? First is to understand how credit card works, especially interest rate charges and grace period. There are tons of credit cards out there. Which one is the best for you? Third is make sure to pay more than minimum monthly payment to lessen the pain from credit cards. So the third topic we'll be discussing is how to use credit cards. If you already have a credit card and know a little about credit cards, plan on opening or applying for a new one or struggle making payments, this will definitely benefit you. Here's what we will cover in this section. What is a credit score and why does it matter? Second, we will talk about what impacts your credit score, how to improve your credit score, and lastly, we talk about how to get a free credit report annually. Let's see a video which explains what's a credit score.
You asked, how does a credit score work? So I'll explain the basics and the time it takes me to make popcorn. A credit score is just a number, but like a bowl of popcorn, the bigger, the better. Bigger? I'll put more kernels in. The better the score, the less risky it is to lenders. The number ranges from 300 to 900, but a score of 750 and up is good. There's more to it than that, though. Your report takes into consideration your score and other information when determining how much of a risk you are to lenders. Someone's writing a report about us? By report, I mean a document that keeps track of your credit history and relevant personal information. Banks, phone companies, and insurers use this report to determine whether you can make a payment or not. There are many different factors that affect your credit score. For example, how many credit requests you make, your payment history, and whether you pay your bills on time. In fact, paying your bills regularly and before the end of the month is a very good practice to adopt. Now, let's say I have a credit card, and the only purchases I've made are Week of the Zombie, Month of the Zombie, and Lunar Month of the Zombie. To pay off the $60 they cost me, I'll make 2 payments of $20 this month and 1 payment next month, because making the minimum payment on time is crucial. Here's a spooky myth. Requesting a credit report will affect your credit score. False. You can get your credit report at any time without worrying about your credit score. It's a win-win. What did you win? A popcorn machine.
So like I said, a credit score is trying to put a number on your credit worthiness. It can impact a lot of things in your life, so it is important to understand how it is calculated and how you can improve if it's too low. Your credit score can impact your ability to borrow money and at what rate. Your ability to sign up for services like phone, utilities, etc. and other items where another party is looking for an independent assessment of your credit worthiness. So when you use credit, you will be building your credit score. It is thus important to have some borrowing to ensure if you want to borrow for a larger purchase, like a house or a car, that a credit rating will be established and positive. One gimmick to build a good credit score is to get a credit card and use that credit card to pay for one or two things a month that you will always pay in full each month, like your cell phone. After having paid off the credit card in full for 12 to 18 months, you'll see a meaningful improvement in your credit score. Your credit score is used by lenders to determine what kind of borrower you are. It can affect your eligibility for certain loans or credit cards, as well as the interest rate you get. A credit score is a numerical summary of the information contained in your credit report at a particular point in time. So if you have any credit accounts, such as a credit card, mortgage, or loans, you will likely have a credit report. In Canada, your credit score ranges from 300 to 900, and 900 being a perfect score. If you have a score between 780 and 900, that's excellent. Do your best to try and stay in this range, as harder to get to this level than it is to stay within this level. If your score is between 700 and 780, that's considered a strong score, and you shouldn't have too much trouble getting approved with a great rate. You may need a credit score of 750 to lease the car you want, but a prospective landlord may be fine with 650, and it's up to each lender to decide. When you start hitting 625 and below, your credit score is getting low, and you will start finding it more and more difficult to qualify for a loan, and will likely pay a higher interest rate. Note that it will take time to improve your score, so have a plan to improve your score. Be patient and stick to the plan. Don't obsess with the exact number, but be aware of where your score fits into the ranges. Meeting future goals depends on your credit score. The two most important things that go into your credit score are payment history. Do you pay all your bills on time, like cell phone, Netflix, hydro, water, etc.? Second is credit utilization, the amount of debt outstanding to a total credit available. As a rule of thumb, try not to have more than 30% of credit limit outstanding at any one time. So if you have $1,000 limit on a credit card, then try not to have more than $300 outstanding at any one at time. For the 10% piece of new credit, differentiate between hard and soft checks. So hard check is when you authorize a lender to check your credit. So that's like mortgage. Several of these within a month will just count as one inquiry. Then there's credit application, rent a property, and new cell phone. And they stay on your credit report for 2 or 3 years. A soft check is when you get your free annual report, a company inquires to see if you qualify for credit, and employer does a background check on you. So correcting past issues will take time. People looking to extend your credit will want to see 12 to 4 months of good behaviors. So paying on time for 1 month won't help you. It needs to be consistent, or it has to be a habit. You can likely access your credit score on your banking app for free. Building upon the prior slide, and to make sure to emphasize how do you improve your credit score. First one is to pay all your bills on time. Your payment history is the single most important factor to improving your credit score. In addition to mortgages, credit cards, and other loans and credit products, your payment history may also include certain accounts like phone bills, utility bills, and even rent. Late or missed payments can lower your score. Second is to keep balances low. Your credit utilization ratio is the amount of available credit that you are using at any given time. For example, if you have a credit balance of 4,500 and the total credit limit is $10,000 from all your credit cards, and the credit utilization ratio is 45%, which is higher than the 30 to 35% recommended. A low credit utilization ratio helps improve your credit score. In contrast, a high credit utilization ratio may lower your score. The next is having a longer credit history. The length of your time that you've had credit products open can affect your credit score. Generally, a longer credit history can improve your credit score. Avoid unnecessary credit applications. Your credit score can decrease slightly each time you apply for credit, such as new credit card or auto loan. This is also called a hard inquiry. The decrease is usually temporary, but some lenders may consider having many credit card applications within a short period of time as a warning flag. Having a mix of credit types. Your credit score may improve if you have different types of credit products, such as credit card, mortgage, and line of credit. However, you should only apply for credit when and if you need it only. The last one is getting a secured credit card. You will need to make a deposit to get one of these cards, so make sure to be dealing with known financial institutions. So your credit score is based on what is in your credit report. Your credit report is a record of how you manage your credit obligations. It contains information on loans for the last 6 years, payment regularity, how much you owe per account, and what your limits are per account. List of authorized lenders who have access to your file. There are 2 credit reporting agencies in Canada. You can get free copies of your report from TransUnion and from Equifax once per year. It is your responsibility to correct any errors on your credit report, so we would encourage you to request a free report from one of the agencies annually. If you have a good credit, it'll give you more leverage in negotiating with creditors. There are a lot of opportunities to spend small amount of money on your credit card. So if you're gaming, there may be offers to buy things for 99 cents at a time. This is just an example. Easy enough to do, especially if your credit card is on file. But be careful that you all of a sudden aren't spending $25 to $50 per month on little things like that. Another potential example is various streaming services. Often there's a teaser rate, and a cost of say $10 to $15 a month isn't much. Even after the teaser rate might not seem like much, but be careful that you don't have half a dozen or much more services in very quick order. Make sure to only purchase streaming services that you use and ensure cancel those that you don't use much. So there's this concept of buy now, pay later has been around for decades. It started as a layaway plans to allow buying a couch and paying for it in a year. So a new approach to buy now, pay later could be a scary development for personal finances as it's easier and more prevalent. You're able to buy a lot of things now. Take them home and then pay in 4 installments as an example. The challenge is to make sure you truly can pay for all of the things you put on buy now, pay later, as there are some new approaches. You can use buy now, pay later on small purchases, which is as low as $100 or $200. These are being offered as studies have shown that you will buy now more than otherwise. So they're developed to help retailers increase sales. There may be negative repercussions down the road if you can't pay later. So these might include fees, penalties, or impact to your credit score. Note how the proposition is pitched to merchants. So those who want you to buy their products. So 25% more sales, 30% higher value sales, and 20% increase in repeat customers. Merchants love buy now, pay later as it increases profits. If you don't have the money to buy something, do your best to avoid paying now, buying now, and pay later. The other one is rent to own plan is typically an agreement for the rental of an item. You will not own the item until you have met the conditions in your rent to own agreement. In addition to your monthly payment, you may have to pay fees, and these can include an additional amount to pay if you want to purchase the item. So if you change your mind or you don't want to purchase the item, you can return it to the company. Some rent to own companies offer an option called same as cash. With this option, you don't pay additional fees. If you pay the full amount within a set amount of days, typically you have to pay the full amount within 90 or 120 days of your purchase. As you can see for the sofa, the retail store has no fees or markup. You just pay $800. But then same as cash, you have to pay 800. It's $800, but then you have the markup, which you have to pay more. And rent to own, there's markup and there's fees to pay, which is even more expensive. A payday loan is a short-term loan with high fees that can make it a very expensive way to borrow money. You can borrow up to $1,500. You must pay the loan back from your next paycheck. In the following provinces, you have up to 62 days to pay it back. That is Alberta, British Columbia, Manitoba, New Brunswick, Ontario. If you can't pay it back on time, you'll face more fees and interest charges. This will increase your debt. Payday loans are meant to cover a cash shortfall until your next pay or for a short period. Avoid using them for ongoing costs such as rent, groceries, or utility bills. If you use them in this way, you may end up in financial trouble. Privately owned companies offer payday loans in stores and online. So, for example, you borrow $300 from Money Mart for fixing the furnace at your house in Feb. If you repay the $300 in 2 weeks, you will pay $351 back to payday lenders. This works out to over a 400% annualized interest rate. So if someone put $100 into an account paying 442% annual interest rate, how much money do you think would be in account after 10 years? Does anybody have any guesses? So if someone put $100 into an account paying 442% annual interest rate, how much money would be in the account after 10 years? Any guesses for this answer? Okay, so if someone paid you 442% interest on $100, after 10 years of compounding, you would have over $280 million. I know that's a lot. Over a $250 million from $100 initially. But wait, if you didn't repay $51 in interest plus $300 original loan in 2 weeks, you would have to pay a penalty of $40. Now you are in essence paying close to $800 interest rate. This can easily get out of control. Please do not use payday lenders, as you can see how fast it can get out of control. So what are the key takeaways from this section? What is the credit score and why does it matter? Second, we talk about how it impacts your credit score, how to improve your credit score. Lastly, we'll talk about how to get a free credit report annually from Equifax or TransUnion. Let's review what we talked about today. First one is managing your debt. There are many different forms and features of debt. It's very, very important to read the contracts before borrowing money. Second, there can be good forms of debt like for school, buying a house, buying a car, or buying a car to get to work, etc. A couple of potential methods to lower your outstanding debt like snowball and avalanche method. Then second one is using credit cards. Understand how credit card works, especially interest charges and grace period. There are a ton of credit cards out there. Which one you should check which one's the best for you. Make sure to pay more than the minimum monthly payment to lessen the pain from credit cards. Coming out of this workshop, you hope you understood how credit card works and the terminology you need to understand when getting a credit card, why it's important to pay off credit card in full monthly, and how to improve your credit score and how to manage your debt so as to reduce your financial stress. Look into student accounts at banks. You can request a free credit report and check out more program resources and make a plan to pay off your credit card. Thank you all for attending today and listening. We have sent a pre-survey. We hope you complete it. I know there'll be a post-survey sent at the end of the session. If you fill out both, you'll be entered into a draw for one of four $50 Tim Hortons gift cards. And don't worry, we won't use your email address for any other reason except the straw. It is important that we ensure these workshops are providing with the information you need, so please complete this post survey. Please, if you have any questions, you can feel free to type it in the chat. The post survey has been put in the chat. Hopefully you all fill that out.
I do have one question for you. Very often you'll go to the bank and be doing some other business or whatever, and they'll tell you, oh, we've got this offer on. Do you want to take on another line of credit or whatever? And it's like a personalized one and for you and so forth. What do you think about this? What should you do in these cases?
I think in banks, they're just trying to get you to get more credit cards, and I think you'll be in more debt. If you really don't need it, I suggest you don't go for it. You have to check what's best for you, I guess.
Often it's always the one that you already have open. So like you've got a credit card and we can increase your credit limit to this, or you've got a line of credit and we can increase your limit to this. We've got this offer on your account. So if you already have it, should you go for increasing the limit or no?
If that's not what you want, I don't think you should increase the limit. And if you're not going to purchase anything more, you don't need to increase your limit if that's not what you want.
The one caveat with the bank specifically and doing that kind of process is if you are pre-approved, it's not considered a hard check. You're not applying for credit. So it doesn't impact your score there. And sometimes having more credit can be beneficial to an extent because it can make it easier to stay within your utilization, right? If you have $1,000 limit, or say you have a $500 limit, your 30% utilization is only $150. Whereas if you increase your limit to $1,000, you now have $300 worth of room. As long as you keep your balance below that, it'll start improving your score. So if you've been pre-approved for something, it could be beneficial, but the big thing is if you're going to look at it as extra money, it's not going to be in your favor, right? If you think, oh, I went from $1,000 limit to a $2,000 limit, and then you end up going from maxing out $1,000 card to maxing out a $2,000 card, then all you've done is taken on an extra $1,000 of debt. If you take on an extra $1,000 limit and you can keep your credit card managed, then it can give you a little bit more wiggle room, especially, it can be nice to have that room if there's an emergency too, that flexibility. But it comes down to, as Eileen's saying, it's you. And if you're somebody who's going to use what's available to you, then maybe you might want to consider whether it's in your best interest to increase what's available. But if you're somebody that's not constantly building their card, then it's there could be some benefits to consider.
So just to be clear then, I don't know if this is a myth or not, but just having the credit, if you don't use it, does it still improve your credit score, or do you have to make sure you use that new credit?
If it's an attachment to your current credit card, then it will help your score whether you're getting into that part of it. If it's taking out a new form of credit, you'll need to use it in some way in order to have it impact your score. So if it's like a new credit card, then you would need to use your old credit card and your new credit card for both of them to benefit your score. But that could be, I think there was an example Eileen mentioned of like put your phone bill on your new card, or keep your phone bill on your old card and use your new card for purchases or something like that, where you're still going to pay off the phone bill on the old card so you don't forget about it, and then you use the new one for purchases, and then you start having access to two different credit streams there.
Perfect, thanks.
Any other questions from anybody? I did also put the post-survey link in the chat. So as Eileen mentioned, if you complete the pre and post survey for the workshop, you'd be entered into a draw for one of 4 $50 Tim Hortons gift cards. Give it a couple seconds in case anybody's typing anything. You are also welcome to unmute and just ask away. And if not, thank you very much for joining us. Hope we were able to learn something, and we have our final workshop in 2 weeks on the 30th. We're looking at buying your first home. So I hope to see everybody back in 2 weeks.
Thank you all for attending today.
Doesn't seem like there's any other questions. So thank you, everybody. Have a great evening.
Thank you.
Thank you.
Thank you.